There are different types of allowances given by Inland Revenue Authorities of Singapore, IRAS. They are Land Intensification Allowance, LIA. Companies that qualify for LIA can claim qualifying capital expenditure incurred on the constructions of a qualifying building or structures. Writing down allowances for intellectual properties rights. To enhance Singapore's attractiveness as a location for businesses to hold and commercialize IPRs, writing down allowances are granted on capital expenditure incurred in acquiring IPRs under Section 19B of the Income Tax Act. Mergers and acquisitions allowance. Company may claim a percentage of the value of the acquisition or merger up to a maximum cap. Capital allowances. Deductions claimable for the wear and tear of qualifying fixed assets such as industrial machinery, office equipment, and sideboards. Company allowances are generally granted in place of depreciation, which is not deductible. Let's go in depth on different aspects of the capital allowances which the company should take note when applying. Who can claim? Companies that carry on a trade or business may claim capital allowances on expenditure incurred on the provisions of plant and machinery for use in its trade or business. An expense is incurred when the legal liabilities to pay has arisen regardless of the date of actual payments of the money. As announced in Budget 2020, capital allowances will no longer be given on expenditures funded by capital grants from the governments or statutory boards that are approved on or after 1st January 2021. This change seeks to eliminate double incentivization where the capital grants are not taxed while the expenditures funded by these grants are eligible for capital allowances. Plants and machinery generally refer to a fixed asset that has the following characteristics. The item is not a trading stock of your company, not for resale purposes. The item functions as an apparatus used for carrying out the business or trade activities of your company. And the item is not part of the setting or part of the premises in which your business is carried on. Those items that are part of the setting or part of the premises may be claimed as renovation or refurbishment instead under Section 14Q deduction. Assets purchased for use by subcontractors and others party. Companies may also claim capital allowances for expenditures on plants and machinery used by its subcontractors in outsourcing arrangements. There must, however, be commercial justifications for companies to allow their subcontractors to use the plants and machinery purchased by the company. Companies must also show that this was done for the purpose of their business. An example is when a company derives cost savings from outsourcing the manufacturing of its products and provides plants and machinery to the subcontractor for the exclusive use of manufacturing its products. Claiming. To claim capital allowances, the tax computations must be submitted with Form C. However, if the company is filing Form CS, it needs to retain the tax computation and submit them upon IRAS request. Deferring capital allowance claims. There are circumstances where companies may wish to defer capital allowance claims. Typically, companies defer capital allowance when the company is in a loss position or the company qualifies for tax exemption for new setup companies. Selling or writing off fixed assets. When a fixed asset is sold or written off, you need to calculate balancing allowance BA or balancing charge BC in capital allowance has been claimed for the assets previously. BA is tax deductible, whereas BC is taxable income. BA and BC are the difference between the sales proceeds and the tax written down value of the assets disposed. Section 24 election, transferring fixed assets to related companies. When a company takes over or buys fixed assets from a related company where there are 50% or more common shareholders, both companies may elect to transfer the assets under Section 24 of the Income Tax Act. The effect of electing for Section 24 is to disregard the sales except for the change in persons entitled to the allowance. In other words, the transactions will not be considered a sales, but a transfer of the assets and its allowances. Methods of capital allowances calculations. There are few methods for calculating capital allowances. There are 100% write-off in 1 year, write-off over 2 years. This is new methods as announced in Budget 2020 for applying in YA 2021 and YA 2022. Write-off over 3 years, write-off over the prescribed working life of the assets. 100% write-off in 1 year, Sections 19A. Under Section 19A, assets that qualify for 100% write-off are computers, prescribed automation equipment, and low-value assets. Some commonly claims prescribed automation equipments are computer, laptop, printers, and computer softwares. Low-value assets. Companies may choose to write off low-value assets in 1 year provided certain conditions are satisfied. A low-value asset is one that does not cost more than 5,000, and the total claim for 1 year write-off of all low-value assets must not exceed 30,000 per YA. If the amount exceeds 30,000, company can still claim capital allowances over 3 years or 2 years for YA 2021 and YA 2022, or the prescribed working life for the low-value asset existing the cap for the YA. Write-off over 2 years. As announced in Budget 2020 and 2021, businesses are given an options to accelerate the write-off over 2 years instead of 3 years or over the prescribed working life of the assets on the cost incurred in acquiring the assets during the basis period for YA 2021 and YA 2022. This is to support businesses who intends to invest in new assets and ease the cash flow of the businesses. The rate of accelerated capital allowance are as follows. 75% of the cost incurred to be written off in the first year, and 25% of the cost incurred to be written off in the second year. No deferment of capital allowance claim is allowed under this option. Write-off over 3 years, Sections 19A. For YA 2009, companies can use this method to claim capital allowance for all assets that qualify for capital allowance. Companies can also choose to defer the capital allowance claims to subsequent YAs. Write-off over the prescribed working life of the assets, Section 19. Under this method, capital allowance is granted over an asset's prescribed working life based on the 6th schedule of the Income Tax Act. To simplify, capital allowance claims Under Section 19, the prescribed working life or assets in the 6th schedule will be streamlined to 6, 12, and 16 years. Our tax specialists will be based on companies' situation in determining the best options for capital allowance claiming to reduce the tax payable while staying compliant with the law. Please stay tuned with us for upcoming webinar, and we will cover more detailed topics such as unutilized corporate tax losses, capital allowances and donations, goods and services tax, personal income tax, and so on.